40.23. That's the Shiller PE ratio right now, here in January 2026. Do you know what the only time in history was when it stood higher than this? December 1999, right before the dot-com crash, obliterated 80% of the Nasdaq's value and sent shockwaves through global markets. And here's what should genuinely concern every investor, every saver, every person with a retirement account or a home or a business. The conditions building in 2026 aren't just similar to what we saw in 2008. They're objectively worse. Because in 2008, we faced one primary crisis centered around residential real estate. In 2026, we're watching 4 separate crises converging simultaneously, each one capable of triggering a financial earthquake on its own, but together, creating a situation that could reshape the economic landscape for a generation. I'm going to walk you through exactly what these 4 crises are, show you the mathematics behind why they're interconnected, explain when the breaking points are likely to arrive, and most importantly, demonstrate what happens to your money, your savings, and your financial security when they do. Let me start by showing you why the expert consensus is so dangerously wrong. Most mainstream economists are predicting no recession in 2026. Deloitte is forecasting 1.4% growth. Morgan Stanley is calling for moderate expansion. JP Morgan has put the recession probability at just 35%. Sounds manageable, doesn't it? Sounds like we're in for a soft landing, maybe a little turbulence, but nothing catastrophic. But here's what you need to understand about these forecasts. These are the exact same institutions that told us in 2007 that subprime mortgages were contained, that the problems in housing were isolated to a few bad actors, that the financial system was fundamentally sound. These are the same experts who assured us in the year 2000 that the new economy had eliminated the business cycle, that internet companies didn't need earnings, because eyeballs were the new currency, that we had entered a permanent plateau of prosperity. These are the same forecasters who have been catastrophically wrong at every single major turning point in modern financial history, not because they're unintelligent, but because their models fundamentally cannot account for what happens when multiple interconnected systems break down at the same time. Let me show you the 4 crises that are converging in 2026, and once you see how they connect to each other, how they amplify each other, how they create cascading failures across the entire financial system, you'll understand why this isn't fear-mongering or clickbait. This is mathematics. This is probability. This is the logical outcome of structural imbalances that have been building for years and are now reaching their breaking point. Crisis number 1 is the commercial real estate collapse, and the numbers here are staggering. $936 billion. That's how much commercial real estate debt is scheduled to mature in 2026 alone. Add to that the $525 billion that matured in 2025. And you're looking at nearly $1.5 trillion in loans that need to be refinanced at interest rates that are roughly double what the original borrowers paid. Let me walk you through the mathematics of why this breaks everything. Imagine a commercial building, an office tower, or a retail center that was financed back in 2021 when interest rates were at historic lows. That borrower locked in a 3% interest rate on their mortgage. Now that loan is coming due, and they need to refinance, but current interest rates are at 6% or higher. That simple doubling of the interest rate means their debt service payment, the amount they have to pay every month just to service the loan, has doubled. But here's where the problem becomes unsolvable. At the same time that their payments are doubling, the underlying value of their building has collapsed because office vacancy rates have exploded to 20% nationally. In some major markets, like San Francisco, vacancy rates are approaching 30%. Austin hit record highs. Major metropolitan areas across the country are seeing unprecedented amounts of empty office space because of the structural shift to remote and hybrid work. So now you have a borrower facing an impossible situation. They owe more on the building than the building is currently worth in the market. Their monthly payment has doubled, and they can't sell the property because there are no buyers willing to pay anywhere near what they owe. What's the rational economic decision in that scenario? They hand the keys back to the bank, they walk away, they default. And we're already seeing this play out in real time. CMBS delinquency rates, that's commercial mortgage-backed securities, hit 6.59% in the third quarter of 2025. For office buildings specifically, the distress rate reached 10.9% in October, up dramatically from 6.7% just 2 years earlier. 278 banks have been specifically identified by regulators as vulnerable due to concentrated commercial real estate exposure. Over 900 banks across the United States are still carrying commercial real estate exposure that exceeds 300% of their capital, meaning if just a fraction of those loans go bad, these banks become insolvent. Think back to 2008 for a moment. In 2008, the problem was residential mortgages. Banks had loaded up their balance sheets with subprime home loans, loans made to borrowers who couldn't afford them, packaged into securities with fraudulent ratings and sold across the global financial system. When those mortgages went bad, banks collapsed, the credit markets froze, and we entered the Great Recession. Today, the problem is commercial mortgages. Banks have loaded up on office buildings, on retail centers, on multifamily properties that are going bad for structural reasons related to how we work and shop and live. It's the same mechanism, just a different asset class. The banking system absorbed roughly $400 billion in losses during the Great Financial Crisis. Commercial real estate losses in this current cycle could easily exceed that number, and the banks are nowhere near prepared for losses of the magnitude concentrated in a single sector. Crisis number 2 is the stock market bubble, and by every historical measure we have, we are in bubble territory. The Shiller PE ratio, also called the cyclically adjusted price to earnings ratio, or CAPE, stands at 40 right now. This is the second highest reading in 140 years of data. The only time it was higher was December 1999, when it hit 44.19. Do you remember what happened next? Over the following 2.5 years, the S&P 500 fell 50%. The Nasdaq fell 78%. Trillions of dollars in paper wealth simply evaporated. The Buffett Indicator, which Warren Buffett himself has called probably the best single measure of where valuations stand at any given moment, compares the total stock market capitalization to GDP. Right now, it sits at 225%. The historical average is between 80 and 100%. Anything above 160% is considered significantly overvalued. Warren Buffett himself said that ratios approaching 200% mean investors are playing with fire. We're at 225%. And then there's the concentration risk that almost nobody's talking about. 7 stocks, the so-called Magnificent Seven, now represent over 30% of the S&P 500's total market capitalization. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, Tesla. If you own an S&P 500 index fund thinking you're diversified across 500 companies, you need to understand that your portfolio's performance is now dominated by just 7 stocks. If these 7 stocks correct, and by correct I mean return to valuations that are anywhere near historical norms, the entire market follows them down. This isn't diversification. This is concentration masquerading as an index fund. The AI boom that's driving these valuations mirrors almost exactly the internet boom of the late 1990s. You have revolutionary technology that's real, productivity gains that are legitimate, massive investment flowing into the sector, and stock prices going parabolic. Then you get a crash that wipes out trillions in paper wealth. The question has never been whether AI is real. The internet was real too. The internet changed the world, but that didn't stop internet stocks from crashing 78% because the valuations had become completely detached from reality. The question today is whether current stock prices reflect economic reality or collective fantasy. At 40 times cyclically adjusted earnings, I would argue fantasy is winning. When KP ratios have exceeded 30 for extended periods throughout history, markets have always, without exception, experienced corrections of 20% or more. At 40, we're not pricing in normal growth anymore. We're pricing in absolute perfection. We're pricing in a scenario where nothing goes wrong, where AI delivers on every promise, where earnings grow at unprecedented rates indefinitely, where interest rates stay favorable, where no recession ever comes, where geopolitical stability reigns, where nothing disrupts the current narrative. And perfection, as we all know, doesn't exist in financial markets or anywhere else. Crisis number 3 is what I call the debt doom loop, and it's the crisis that makes all the others harder to solve. $38 trillion. That's the current national debt of the United States as of this month. It was $36 trillion at the start of 2025. We're adding roughly $2 trillion per year in new debt, even during what's supposed to be good economic times. But here's the number that should terrify every taxpayer and every bond investor. $1 trillion. That's what the federal government paid in interest on the debt in fiscal year 2025. Interest payments are now the second largest line item in the entire federal budget, behind only Social Security. And ahead of Medicare, ahead of national defense, ahead of everything else we spend money on as a country. The Congressional Budget Office projects that interest payments will hit $1.8 trillion annually by 2035, but that projection is based on the assumption that interest rates will decline from current levels. What if that assumption is wrong? What if rates stay elevated or even rise further? Every 1% increase in average interest rates across the maturity structure of federal debt adds roughly $380 billion in annual interest expense. The debt doom loop works like this, and it's a self-reinforcing cycle that feeds on itself. High debt requires high borrowing to roll over maturing obligations and fund ongoing deficits. High borrowing puts upward pressure on interest rates because you're increasing the supply of bonds in the market. Higher interest rates increase interest expense on both new borrowing and refinancing of existing debt. Higher interest expense increases the deficit because you're paying more just to service the debt. Higher deficits require even more borrowing to fill the gap. And the cycle feeds on itself, getting worse with each iteration until something breaks. In 2026, the federal government will spend roughly $1 trillion just paying interest on money we've already borrowed. That's $1 trillion that doesn't build infrastructure, doesn't improve education, doesn't strengthen defense capabilities, doesn't provide health care, doesn't do anything except service previous borrowing decisions. And here's what makes 2026 particularly dangerous on the debt front. The debt ceiling was reinstated in January 2025 at $36.1 trillion. We've already blown past that limit. Congress will need to raise it again, which means another debt ceiling showdown, another period of political brinkmanship, another opportunity for markets to panic about whether the United States government might actually default on its obligations. Another credit rating downgrade is entirely possible. Moody's already cut the United States from its highest AA rating back in May 2025, following the earlier downgrades from S&P and Fitch. We're running out of runway here. The 2008 crisis was fundamentally triggered by private sector debt. It was mortgages, credit cards, corporate borrowing that went bad and brought down the financial system. The next crisis will be triggered, or at least significantly amplified, by sovereign debt, by government borrowing that has reached levels that are historically unprecedented in peacetime. And that's harder to fix, because the entity that normally does the fixing, the federal government, is itself the source of the problem. Crisis number 4 is the consumer breaking point, and this is where the theoretical becomes intensely personal for millions of Americans. $1.66 trillion in auto loan debt outstanding. The average monthly payment is $748. Subprime auto loan delinquencies have reached 6.65%, the highest level since tracking began in 1994. 1.73 million vehicles were repossessed in 2024, the highest number since 2009, since the depths of the Great Recession. 28% of all trade-ins are underwater, meaning people owe more on their current car than the car is worth when they try to trade it in. The average negative equity is $6,900. Nearly 1 in 4 underwater borrowers owes more than $10,000 more than their vehicle is worth. Credit card debt exceeds $1.1 trillion with average APRs above 20% and delinquencies climbing month after month. Student loan payments resumed after years of forbearance during the pandemic, adding another monthly obligation that millions of Americans had temporarily escaped. The average American consumer is, by any objective measure, tapped out. Here's the indicator that terrifies economists who understand consumer credit dynamics. Car loans are typically the absolute last payment that Americans skip before they start missing mortgage payments or defaulting on credit cards. Why? Because you need your car to get to work. Without the car, you can't earn the income you need to pay all your other obligations. The car payment comes first, even before food in some cases, because maintaining transportation is existential for most working Americans. So when car loan delinquencies spike, when repossessions surge, it means that consumers have exhausted every other option available to them. They've cut discretionary spending, they've stopped going out to eat, they've canceled subscriptions, they've maxed out their credit cards trying to stay current, they've depleted their savings accounts, they've borrowed from family and friends, they've done everything they possibly can, and they're still falling behind. They're at the end of their financial rope. Subprime borrowers aren't some marginal group that doesn't matter to the broader economy. They're the canary in the coal mine. They're the early warning system. When subprime borrowers start breaking under financial stress, it signals that the pressure is building throughout the system and will soon move up the income ladder to prime borrowers, to middle-class families, to people who thought they were financially secure. And right now, subprime is breaking at rates we haven't seen since 2008, since the worst consumer credit crisis in modern American history. Now let me show you how these 4 separate crises connect to each other and create feedback loops that amplify the damage exponentially. Because individually, any one of these problems could potentially be contained by policy responses, by regulatory intervention, by market adjustments. But together, they create cascading failures where each crisis makes the others worse, in a self-reinforcing spiral that becomes impossible to stop once it gets going. Commercial real estate losses hit bank balance sheets. Banks that suffer losses become more cautious, more risk-averse. They tighten lending standards across all categories, not just commercial real estate. They require higher credit scores, larger down payments, more documentation, more collateral. Tighter lending slows economic activity because consumers and businesses can't access credit to make purchases or investments. A slower economy means businesses aren't hiring or even laying off workers. Higher unemployment means more consumers default on their obligations because they've lost their income. More consumer defaults mean more losses for banks, which makes them tighten lending even further. The cycle accelerates and feeds on itself. Simultaneously, if stocks correct 20 to 30% from current levels, which is entirely plausible given current valuations, the wealth effect reverses dramatically. Consumers who felt wealthy because their 401k had doubled, because their brokerage statement showed big gains, because their home equity had increased, suddenly feel poor when those paper gains evaporate. They cut spending dramatically. They postpone purchases. They cancel vacations. They stop remodeling the house. Business revenues drop because consumer spending is 70% of GDP. Corporate earnings fall because revenues are declining. Companies respond with layoffs to cut costs. More layoffs mean more defaults. More defaults mean more bank losses. The stock decline becomes self-fulfilling as declining earnings justify lower valuations, which causes more wealth destruction, which causes more spending cuts, which causes more earnings declines. And through all of this, running underneath everything like a fault line ready to rupture, the federal government can't provide the kind of massive fiscal stimulus it deployed in 2008 or in 2020 during the pandemic. Why? Because it's already running $2 trillion deficits during what's supposed to be a strong economy with full employment. Interest payments already consume $1 trillion annually. There's no fiscal space left. There's no room in the budget to add another trillion or two in stimulus spending without risking a bond market revolt, without risking a currency crisis, without risking a complete loss of confidence in U.S. government debt. The Federal Reserve, similarly, can't simply cut interest rates to zero again and print unlimited money like they did in response to 2008 and 2020, because inflation isn't dead. It's still running above the Fed's 2% target. The inflationary pressures from pandemic-era money printing are still working their way through the system. If the Fed cuts rates aggressively and prints trillions more, they risk reigniting inflation, potentially even triggering stagflation, that nightmare scenario where you have high inflation and economic contraction happening simultaneously. The Fed is trapped between two objectives that are fundamentally in conflict. They need to fight inflation, which requires keeping rates elevated, but they also need to support the economy and prevent a financial crisis, which requires cutting rates. They can't do both. They have to choose, and either choice has severe consequences. In 2008, we had one crisis, residential real estate, and we had unlimited policy ammunition to fight it. We could cut rates to zero. We could print trillions. We could pass massive fiscal stimulus. We could bail out banks. We could deploy every tool in the monetary and fiscal policy toolkit without constraint. In 2026, we have 4 interconnected crises, and we have essentially no ammunition left. That's the fundamental difference. That's why 2026 could very well be worse than 2008. Not because any single crisis is necessarily larger, but because the system has no shock absorbers remaining. Now let me address the objections, because I know what the skeptics are thinking right now. First objection, the economy is resilient. GDP growth is positive, unemployment is low, the stock market is at all-time highs. Everything looks fine. Here's the problem with that argument. GDP was positive throughout 2007. Unemployment was low throughout 2007. Stocks were hitting all-time highs in October 2007. The economy looked absolutely fine, right up until the moment it didn't. Recessions are only visible in the data with hindsight. By the time the official data confirms that a recession has begun, you're already 6 months into it. The indicators I've shown you, the commercial real estate stress, the stock market valuations, the debt levels, the consumer delinquencies, these are forward-looking indicators. They're telling you what's coming over the horizon, not what's already visible in the rearview mirror. Second objection, banks are stronger now than they were in 2008. They have more capital. Regulations are tighter. Post-crisis reforms have made the system safer. That's partially true. Banks do have more capital than they had in 2008, but they have more capital for the risks that regulators anticipated based on the last crisis. They don't have adequate capital for concentrated commercial real estate exposure at this scale. 900 banks with commercial real estate exposure above 300% of their capital. 278 banks already identified by regulators as vulnerable. The regulatory framework was designed to prevent the last crisis from happening again. It always is. But the next crisis always finds the gap, always exploits the vulnerability that wasn't anticipated, always comes from the direction nobody was watching. Third objection, the Fed will save us. They'll cut rates, they'll print money, they'll do whatever it takes just like they always have. The Fed's balance sheet peaked at nearly $9 trillion. They've been trying to shrink it to normalize monetary policy, to reduce their holdings. Inflation remains above their target. If they cut rates aggressively, if they start printing trillions more, they risk reigniting inflation, potentially triggering a loss of confidence in the currency itself. Printing money when your debt to GDP ratio is already 120%, when you're already running massive deficits, when inflation is still elevated, that's how you get a currency crisis. The Fed's tools were designed for deflationary recessions, for situations where you can cut rates to zero without consequences. What happens when the crisis is inflationary or potentially stagflationary? What happens when rates can't go to zero because inflation won't allow it? We're about to find out, and the answer may not be pretty. Fourth objection, this time is different. AI will drive productivity gains that justify current valuations. Technology will save us from recession. We've heard this story before. The internet was going to save us in the year 2000. It was real technology with real productivity gains and real revolutionary potential. And stocks still crashed 78% because the valuations were insane. The technology was absolutely real. The internet did change the world, but that didn't stop the crash. AI is real. The productivity gains will probably be substantial. NVIDIA's revenue growth is real. But when the CAPE ratio hits 40, when the Buffett Indicator hits 225%, you're not paying for technology anymore. You're paying for a narrative, for a story, for a dream. And stories don't have earnings. Stories don't have cash flows. Eventually, reality intrudes and prices adjust to reflect actual economic fundamentals rather than collective fantasies about the future. So what should you actually do? Let me give you 6 concrete steps to position yourself for what's likely coming. First, stress test your portfolio for a 30 to 40% drawdown. Look at your current holdings and calculate what happens if stocks fall 30 or 40% from current levels. If you can't emotionally or financially stomach that kind of loss, if it would devastate your retirement plans or force you to sell at the bottom, then you need to reduce your exposure now before it happens, not after when it's too late. Second, build substantial cash reserves. 6 to 12 months of living expenses minimum, preferably more if you can manage it. In a credit crunch, liquidity becomes extraordinarily valuable. The people who had cash sitting on the sidelines in 2008 and 2009 were able to buy quality assets at generational lows. The people who were fully invested and had no cash were forced to sell at the worst possible time to meet their living expenses. Cash is optionality. Cash is flexibility. Cash is the ability to take advantage of opportunities when everyone else is panicking. Third, reduce your exposure to rate-sensitive assets. Long-duration bonds that get crushed when rates stay elevated. Highly leveraged companies that can't service their debt when refinancing costs double. Commercial real estate investment trusts that are directly exposed to the crisis I've described. Anything that fundamentally breaks when interest rates stay higher for longer than the market currently expects. These are not the assets you want to own in the environment that's developing. Fourth, diversify geographically beyond the United States. International developed markets are trading at significant discounts to U.S. markets right now. The Shiller PE for international developed markets is roughly half the level of the U.S. market. When the U.S. corrects, when American valuations come back down to earth, capital will flow elsewhere, looking for better opportunities, looking for markets that aren't as overvalued. You want to already be positioned there before that rotation happens. Fifth, own hard assets, particularly gold. Gold hit record highs in 2025 for very specific reasons. Central banks around the world are buying gold at the fastest pace we've seen in decades. They're deliberately diversifying their reserves away from dollar-denominated assets. They see the same debt dynamics, the same fiscal trajectory, the same risks that we've been discussing. If central banks are diversifying out of dollars and into hard assets, maybe individual investors should consider doing the same. Sixth, pay very close attention to the early warning signals. Watch commercial mortgage-backed securities delinquency rates. Watch auto loan delinquencies and repossessions. Watch the yield curve for signs of inversion or steepening. Watch bank earnings, reports for unexpected losses, or provisions for bad loans. When these indicators start deteriorating faster than expected, when the pace of decline accelerates, it means the timeline is compressing and events are moving faster than the market anticipated. The mainstream forecast right now is for a soft landing, a mild slowdown, no recession, moderate continued growth, everything basically fine with maybe a few bumps along the way. That's the base case that most economists and most market strategists are working with. But base cases assume nothing goes wrong. Base cases assume that all the various systems continue functioning normally, that no unexpected shocks hit the economy, that policy responses work as intended. And right now, 4 major systems are all simultaneously flashing warning signs that something is fundamentally wrong. Commercial real estate has $936 billion in debt maturing in 2026 alone. Banks are massively exposed. Property values are falling. Vacancy rates are elevated. Refinancing at double the interest rate is creating impossible situations for borrowers. The stock market has a Shiller PE ratio of 40 and a Buffett Indicator of 225%, with extreme concentration in just 7 stocks that dominate index performance. Government debt stands at $38 trillion, with $1 trillion in annual interest payments and another debt ceiling showdown on the horizon. Consumer stress is showing up in record auto loan delinquencies, record negative equity in vehicles, record repossessions, maxed out credit cards, and depleted savings. Any one of these could potentially be the trigger that sets everything else in motion. All of them together create conditions for something that could be worse than 2008. Not because any single crisis is necessarily larger in absolute terms, but because the system has no shock. Absorbers left no policy, ammunition remaining, no fiscal space for stimulus, no monetary space for aggressive rate cuts, no margin for error. 2008 had a crisis and a response. We deployed massive fiscal stimulus packages. We cut interest rates to zero. We implemented quantitative easing on an unprecedented scale. We bailed out major banks and financial institutions. We threw every tool in the policy toolkit at the problem, and it worked eventually, though at enormous cost. 2026 will have a crisis and severely constrained responses. High debt levels limit fiscal stimulus. Elevated inflation limits aggressive rate cuts. Political dysfunction limits coordinated action across agencies and branches of government. The tools available to policymakers are significantly duller than they were in 2008. The problems they'll be facing are significantly sharper. Here's the uncomfortable truth that nobody in a position of authority wants to say out loud. Nobody knows exactly when this breaks. It could be first quarter of 2026. It could be late 2026. It could even be 2027 if things hold together longer than the fundamentals suggest they should. The precise timing is genuinely uncertain because financial markets can remain irrational longer than seems possible, but the direction is not uncertain. You cannot indefinitely run a 40 Shiller PE ratio alongside a 225% Buffett Indicator, alongside $1 trillion in annual interest payments, alongside 20% office vacancy rates, alongside record consumer delinquencies. Something has to give. Some part of this structure has to break under the weight of these accumulated imbalances. The question that matters for you personally is whether you will be positioned to survive and potentially thrive during what's coming, or whether you'll be another casualty of the next financial crisis, another person who saw their retirement dreams evaporate, another family that lost their home or their savings or their financial security because they didn't prepare. The data I've shown you is all public. The warning signs are flashing in plain sight for anyone willing to look at them objectively. The same experts who completely missed 2008, who told everyone that housing prices couldn't fall nationally, who said subprime was contained, who assured the public that the financial system was sound right up until it collapsed, those exact same institutions and experts are telling you right now that everything is fine, that we're heading for a soft landing, that you have nothing to worry about. You have to decide who to believe. You have to decide whether to trust the institutions that have been wrong at every major turning point, or whether to trust the objective data showing extreme valuations, extreme debt levels, and extreme stress in multiple critical systems. The bill for 20 years of easy money, for zero interest rate policy, for quantitative easing, for massive deficit spending, for pretending that you can print unlimited money without consequences, that bill is coming due. 2026 may very well be the year when the check arrives and someone has to pay it. The question is whether it will be paid with someone else's wealth through a controlled adjustment, or whether it will be paid with your wealth through a financial crisis that catches you unprepared. Let me add one final layer to this analysis by examining the historical pattern, because this isn't the first time we've been through this cycle, and the pattern is remarkably consistent across different eras and different asset classes. Every major financial crisis in modern history follows essentially the same sequence. First, you get excess, then euphoria, then exhaustion, then collapse, then reset. We've seen this pattern play out in 1873 with railroad speculation, in 1929 with stocks bought on margin, in 2000 with internet companies that had no earnings, in 2008 with mortgage-backed securities that had fraudulent ratings. The names change, the specific assets change, but the underlying pattern doesn't change because human psychology doesn't change, and the mathematics of debt doesn't change. In the 1870s, the excess was railroad speculation. Everyone believed that railroads were the transformative technology that would change everything, which was actually true. Railroads did transform America, but that didn't stop the spectacular crash when the speculation got ahead of reality. In the 1920s, it was stocks bought on margin with borrowed money, with everyone convinced that prosperity was permanent. In 2000, it was internet companies with no revenue, no profits, no business model beyond burning venture capital, but everyone believed the old rules didn't apply anymore. In 2008, it was mortgage-backed securities with the AAA ratings that were actually filled with subprime garbage. In 2026, it's AI stocks trading at 40 times earnings. Commercial real estate that needs to refinance at double the interest rate. Government debt approaching $40 trillion and consumers who are maxed out on every form of debt available to them. Different names, different assets, same fundamental pattern of excess leading to inevitable correction. The euphoria phase is always identical regardless of the era. Everyone says this time is different. We've evolved past the old rules. Technology changes everything. We have smart people in charge who understand the new paradigm. The old metrics don't apply anymore. Then you reach exhaustion. The first small cracks start to appear. Subprime goes bad. A prominent lender fails. Delinquencies tick up slightly. And the experts immediately say it's contained, it's isolated, it's not systemic, there's no reason for concern. Then comes collapse. What was supposedly contained suddenly isn't contained at all. What was supposedly isolated turns out to be deeply interconnected with everything else. The fire spreads from one institution to another, from one market to another, from one country to another. Then finally you get reset. Prices fall back to levels that actually make economic sense. Assets transfer from weak hands who bought at the top to strong hands who had cash to buy at the bottom. The cycle begins anew with a cleaned up system, and then slowly, gradually, the whole pattern starts building again. We're currently in late euphoria transitioning into early exhaustion. The small cracks are appearing. Commercial mortgage-backed securities delinquencies are rising. Auto loan defaults are accelerating. Bank vulnerabilities are being identified by regulators. But the experts are still saying contained, still saying isolated, still saying this time is different because of AI or because of some other narrative. The historical pattern says otherwise. The pattern says we're following the exact same trajectory that we've followed numerous times before. The pattern is never different in its fundamental structure. Only the names and the specific assets change. In 2008, Lehman Brothers collapsed on September 15th, and that was the moment when everyone realized the crisis was real and systemic. But the warning signs actually started back in 2006 with rising mortgage delinquencies, with the first subprime lenders going bankrupt, with home prices starting to roll over in certain markets. There were 2 full years of warning signs that most people ignored because the experts kept saying everything was contained and under control. The warning signs for whatever is coming in 2026 started back in 2023. Commercial real estate stress was already becoming apparent. Consumer delinquencies were starting to tick up. Bank earnings were showing pressure. We're now 2 years into what may be the warning phase. Just like 2006 and 2007 were the warning phase before the 2008 crisis. The question is, how much longer until we hit our September 15th moment? Until we hit whatever the Lehman Brothers equivalent will be this time around? I am not predicting a specific date, because nobody can predict the exact timing of when confidence breaks and panic takes over. But I am saying with confidence that the conditions exist right now. The fuel is stacked and ready to burn. The kindling is absolutely dry. All that's missing is the spark, the match that sets it all on fire. And in financial markets throughout history, those sparks always eventually appear. A bank failure, a major default, a policy mistake, a geopolitical shock, something provides the spark and everything ignites. The prudent response to this situation isn't panic. Panic doesn't help anyone and usually causes people to make terrible decisions at terrible times. The prudent response is preparation. You don't have to successfully time the exact moment when the crisis begins. That's impossible, and trying to do it will drive you crazy. What you have to do is position yourself so that when the crisis eventually arrives, whenever that is, you're not destroyed by it. You're ready to weather it, to survive it, and potentially even to take advantage of the opportunities it creates. Cash provides optionality and flexibility. When everyone else is forced to sell, you can buy. Low debt provides resilience and staying power. When credit markets freeze up, you're not dependent on refinancing. Diversification provides protection against any single point of failure. Hard assets like gold provide insurance against currency debasement and loss of confidence in paper assets. These aren't predictions about what will happen on a specific date. These are preparations for a range of possible scenarios, positioning yourself to be resilient regardless of exactly how events unfold. 2026 may turn out to be the year when everything finally breaks, when all these accumulated imbalances finally demand resolution, when the bill for decades of easy money finally comes due. Or 2026 may turn out to be another year where everything somehow holds together, where we get another round of extend and pretend, where policymakers find another way to kick the can down the road for a while longer. I honestly don't know which scenario will play out, and anyone who claims to know with certainty is either lying or delusional. What I do know for certain is that the risks are elevated to levels we haven't seen since the lead up to previous major crises. The warning signs are flashing across multiple systems simultaneously. And the people who prepared for 2008 before it happened, who built cash reserves, who reduced leverage, who positioned themselves defensively, those were the people who not only survived but prospered in the aftermath by buying quality assets at once-in-a-generation prices. The choice is genuinely yours to make. You can believe the experts and institutions who are calling for a soft landing, for mild slowdown, for moderate continued growth with no major disruptions. Or you can believe the objective data showing a Shiller PE at 40, showing commercial mortgage-backed securities delinquencies at 7%, showing auto loan defaults at 30-year highs, showing $1 trillion in annual interest payments. The experts have a track record you can examine. The data has a track record you can examine. You have to decide which one is more reliable, which one you're going to trust with your financial future. History doesn't repeat itself exactly. The specific details are always different, but history absolutely does rhyme. The patterns echo.